Rates. The Fed has cut rates 3 times in 2019. The signaling is that there may be a pause before any more rate cuts. If the unemployment rate were to surprise markets and the Fed and move steadily higher, then the Fed would cut rates aggressively and go back to quantitative easing. The rate outlook, though, is clearly asymmetric. There is little chance of any scenario with rate hikes, as the Fed would be quite happy to allow an overshooting of its inflation targets. We also note that the Fed is committed to adding reserves to prevent any disruption in the overnight financing markets as occurred in September. This means the Fed's balance sheet will grow a bit, but this should not be interpreted as a return to quantitative easing, as it only involves the Fed buying extremely short-term assets with no impact on the Fed's stated range for the federal funds rate. Equities. Equity markets are awaiting a trade deal or not. A small Phase 1 deal appears priced into equity markets. A grand deal, unlikely as it may be, would be a positive surprise for the markets. The longer-term reality, though, is that profit growth is very slow due to the trade war raising supply chain costs, and only if tariffs actually get rolled back would profit enthusiasm return. Gold. Gold appears to be trading expectations of future rate cuts. The 2020 outlook on that score is very cloudy. As already noted, a recession would mean big rate cuts and potentially rising gold prices. No recession, our base case, makes more rate cuts much more likely and makes it much more difficult to support a sustained gold rally. I'm Blue Putnam, Chief Economist, CME Group.